Hello everyone. I'm glad to be here for the next lecture of this mini course. For those of you who are new to the channel, this is Eric, the voice behind Markats. Today's topic is a special case, since we're diving deep into the futures trading process. Likewise, we'll see the three main uses for it. I'm talking about speculation, arbitrage, and hedging. That's why I'll divide this lecture in two parts so that we can cover the fundamentals more thoroughly. So, sit back, relax, and enjoy the ride. This section aims to understand how a person who does not need to buy or sell a particular asset can operate in this market and exit his position before expiration. That is, before he's obliged to deliver or receive the underlying asset. Learning how you can easily get in and out of the futures market by speculating on rising or falling prices, much like what happens on the stock market, is key to understanding the sheer volume that moves this market. The great liquidity of futures exists thanks to the fact that any investor, whether a speculator, hedger, or arbitrager, can take buying or selling positions by depositing small cash guarantees, which before expiration can be cancelled with an identical transaction, but with an opposite purpose. Opposite in the sense that if you enter the market with a buying commitment, that means buying the futures contracts, you can exit by offsetting such positions before expiration with an identical commitment, but with an opposite sign. That means selling the same numbers of contracts of the same expiration and vice versa. Likewise, if you enter the market with a commitment to sell, that means selling futures, you can offset them before expiration with an identical commitment, but with an opposite sign. In this case, that means buying the same number of contracts of the same expiration. The vast majority of open contracts, to be more specific, 95 to 97% of the total, do not expire. That means they're cleared before that date and do not give rise to any actual delivery of the underlying asset. Through various examples, this section aims to explain the peculiarities of trading in financial futures, whether for purposes of speculation, hedging, or arbitration. Speculative trading with futures can be seen as a bet. Whoever buys futures on the underlying asset, whether it be wheat, gold, stocks, currencies, bets that the price of that underlying good will rise before expiration, and whoever sells futures bets that its price will fall. As simple as that. Let's take a couple of speculators in the silver futures market. Let's call them William and Nelson Hunt, where they currently perform an analysis of the silver price trend and conclude that the price of silver will rise significantly in the coming weeks or even months. We're on January 12th, and William and Nelson want to try to cash in on their bullish expectations on the price of silver. They reach out to their Chicago futures broker and give him the following buying order. Buy 5 silver futures due March. You may still don't know what exactly this transaction means, but executing it is similar to executing an order to buy publicly traded shares. The broker looks at the quote screen for that particular market and informs the investors that March silver futures prices are currently at, say, $6.8 and $6.20 per silver ounce. That is, the best price for those who want to buy at that time is $6.08 per silver ounce. In similar fashion, the best price for those who want to sell at that time is $6.20 per silver ounce. William and Nelson tell their broker, for example, that they want to enter an order to buy 5 futures at $6.14 per silver ounce to see if any seller accepts it. A few moments later, someone agrees to sell those 5 futures at $6.14 per silver ounce and the transaction is closed. In short, William and Nelson just carried out the following operation on January 12th. The purchase of 5 futures on silver with expiration March at $6.14 per silver ounce. What did William and Nelson actually buy? Well, today, January 12th, they haven't bought anything. In our example, William and Nelson Hunt committed to the clearinghouse on January 12th to buy 25,000 ounces of silver since they bought 5 contracts, and every contract contemplates 5,000 ounces of silver on March 15 at $6.14 per silver ounce. Let me be more specific. Whoever buys futures do not buy anything. Simply deposits a cash guarantee at the clearinghouse and agrees to buy, legally with the same clearinghouse, something at a future date and at a price determined at the time of the transaction. To familiarize yourself with the terminology used in derivatives markets, keep in mind that the following terms are used interchangeably with respect to their operations. Buying, going long, or taking a long position are 3 expressions that mean the same thing. Similarly, selling, going short, and taking a short position are 3 expressions that also mean the same thing. From now on, I will use any of these expressions interchangeably. If William and Nelson go long all the way to maturity, that is March 15, without doing anything else, they will receive the 25,000 silver ounces. But William and Nelson are mere speculators who neither need nor want to own silver. They only intend to make money in the event that silver prices rise before March 15, assuming the risk that if silver prices drop further, they will lose money. William and Nelson take a risk in exchange for a possible profit. That is a speculation and nothing more. What will William and Nelson do then? Well, before the expiration, again March 15, they will notify their broker about a sell order with identical features to the buying order, but with the opposite sign to close or compensate their initial position. In their case, since the first order was buying 5 March silver futures, before expiration, they will have to make a position where they sell 5 March silver futures. Let's imagine that we're at the beginning of March, on Friday, March 9, at 8:30 in the morning, where only 5 working days remain before the expiration date. In comparison to the price of January 12, silver has indeed risen in price substantially. Good for William and Nelson. They notify their broker and give him the following sell order. Sell 5 silver futures due March. The broker gets the price of $49.45 per silver ounce. Ultimately, the Hunt brothers have won a little more than $1 million. Just as we have seen, William and Nelson have been in and out of the futures market without ever touching a single ounce of silver. Dear viewer, remember, more than 95% of transactions in the futures markets do not reach maturity and do not result in any actual delivery of the underlying asset. William and Nelson have been able to get in and out without having to carry the silver, thanks to the fact that his legal counterpart in both transactions has been the clearinghouse, and the contracts are standard. Remember, same quantity, quality, expiration, and delivery process? William and Nelson Hunt made a commitment to buy and then sell to the clearinghouse, and in both cases, the contracts sold and bought are identical, perfectly offsetting the purchase commitment with the sales commitment. In short, there is simply a settlement between the two parties, the Hunts and the clearinghouse, which gave the Hunts a huge profit of more than $1.08 million. In a later video, we will cover the exact way in which people make transactions in futures. Particularly, we will see the cash guarantees or margin accounts, daily profit and loss settlements, and more. But before we continue, if you, dear viewer, are liking this video, please share some love and give me a thumbs up. I know that at this point it's kind of a cliche, but it does make a difference. Your engagement with this channel keeps me creating valuable content for you. Let's get back to the good stuff. In the event that silver had fallen in price, let's say it falls to $5.50 per silver ounce, the Hunts will also offset their initial commitment before expiration with another of the opposite sign, but in this case, they would be taking losses. To be more specific, they would lose 64 cents per silver ounce, multiplied times the 5 contracts, each for 5,000 silver ounces. Then, they will lose exactly $16,000 in total. Whether the market trades in the hunt's favor, making a profit with rising prices, or against them, taking a loss if prices fall, they will never want to hit expiration and have to receive thousands of silver ounces that they won't know where to store, transport, and eventually sell. Speculators like the hunt almost never hold to maturity and promptly close their commitment by taking an opposite position before the expiration date. In fact, if they wish to continue their bet, whether bullish or bearish, they can immediately open a position identical to the initial one, but at a later expiration. This action is also known as a rollover. Usually, in our daily life, we have assumed that we cannot sell what we do not have. I mean, for the most part, it can even be considered illegal. But the derivatives market paint a different picture. When dealing with a forward transaction, such as in futures trading, you can start by selling and before expiration, buying to offset your position. Financially, the ultimate goal of buying and selling, or selling and buying, is to make a profit. Let's recall the simplest formula of any business. Profit equals sales price minus purchase price. It's always about the strategy of selling high and buying low, regardless of which one is done first. If the expectation is that the price will go up, I will buy now and sell later. If the expectation is that the price will go down, I will sell now and buy later. Let's go back one more time to the hunt's initial example. But now, suppose that the hunts, in doing their first analysis regarding the silver price trend, arrive to the conclusion that silver will drop in price significantly in the coming weeks or even months. Remember that we're on January 12th. William and Nelson want to try to cash in on their bearish expectations. They reach out to their futures broker and give him the following sell order. Sell 5 silver futures due March. His broker then gets the price of $6.08 per silver ounce. That is, someone agrees to buy those 5 futures at that price and the transaction is executed. And so, the Hunt brothers have opened the following short position, selling 5 silver futures expiring March at $6.08 per silver ounce. Remember that the Hunts, today January 12th, have not sold anything. They have simply deposited a cash guarantee with the clearinghouse to open a sell commitment of 25,000 silver ounces on March 15 at $6.08 per silver ounce. If the price goes down, and on March 9th, William and Nelson close their short position by buying 5 silver futures in March for, say, $5.48 per silver ounce, the transaction will have reported the following benefits. On January 12th, we have the sale of 5 silver futures expiring in March at $6.08 per silver ounce. Then, on March 9th, we have the purchase of 5 silver futures expiring in March at $5.48 per silver ounce. That way, we get a profit of 60 cents per silver ounce times the 5 contracts, each for 5,000 silver ounces. That gives us a total profit of $15,000. In short, if a speculator believes that an underlying asset, whether it be silver, wheat, the Japanese Nikkei index, IBM stock, or you name it, will fall in price in the next future, he will sell futures on that underlying asset with the purpose of buying them at a later date. In the examples above, speculation was being made on the price of silver going up or down. But in which market? The spot market? The futures market? Maybe both? In reality, both markets are correlated, and their prices move in similar fashion, since if that wasn't the case, and the prices of both markets were mismatched, the arbitrageurs would enter and act by buying the one that is undervalued and selling the other one that is overvalued simultaneously, causing a rebalancing of their prices. Let me explain you the latter. If, for example, in the spot silver market, remember where silver is bought and sold with immediate delivery, the price at 9 a.m. on March 9th was around $6.06 per silver ounce.
would it be possible that on the same day, at the same time, the price of silver futures due March 15, that is just 5 working days before expiration, was, for example, $6.36 per silver ounce? Well, dear viewer, that's impossible. Why? Well, just think about it. What would you do in this market situation? Surely, you would buy silver in the spot market at $6.08 per silver ounce, and at the same moment, you would close a sale of futures at $6.36 per silver ounce, in which you would earn in that operation, in gross terms, the difference of 28 cents per silver ounce, which, even discounting the associated costs, it will allow you to achieve a good net profit. But if there is this possibility of sure profit, investors will buy in the spot market and at the same time open short positions in the futures market, so that in the spot market, due to buying pressure, the price of silver will eventually rise. In the same way in the futures market, due to the selling pressure, the price of silver futures will fall. Thus, arbitrage is a timely opportunity operation, which allows profit to be obtained without assuming a theoretical risk, on the basis that the prices of two markets linked to each other have become mismatched. The effect of arbitrage will be that the price difference between the two markets will decrease drastically until it reaches zero. At this point, it is necessary to introduce the concept of carry cost, also known as cost of carry or carry charges, which will lead us to the concept of the theoretical futures price. We have already seen that a significant difference between both markets is impossible for a prolonged time, since arbitrageurs would enter buying in one market and selling in another. But if the difference between the two prices is less, would it be possible to carry out an arbitrage strategy? Well, let's go back to silver, shall we? If on March 9 at 9:10 a.m. in the spot market, silver is trading at $6.20, and at the same moment, in the futures market, the March silver futures contract is trading at $6.22 per silver ounce, would there be a profit to be made by buying silver in the spot market and taking a short position on the March silver futures? Would this arbitrage strategy bring certain benefits? Here it depends on the cost associated with this arbitrage opportunity, whose name is, you guessed it, the cost of carry. Let's see. If, for example, I buy 5,000 silver ounces in the spot market at $6.20 per silver ounce, and at the same time, I sell one futures contract on silver maturing in March at $6.22 per silver ounce, apparently, I will earn the difference of 2 cents per silver ounce times my futures contract that covers 5,000 silver ounces. That gives me a total profit of $100. However, in reality and step by step, the transaction is as follows. First, on Friday, March 9th at 9:10 a.m., I bought the 5,000 silver ounces at $6.20 per silver ounce on the spot market. That means I pay in cash $30,000 and they deliver those 5,000 silver ounces, usually within 2 business days. Simultaneously, also at 9:10 a.m., I sold one March silver future contract for Thursday, March 15 at $6.22 per silver ounce, and I deposit a cash guarantee of, say, $4,000 with the clearinghouse. And second, the transaction in the spot market forces me to store, transport, and perhaps even insure those 5,000 silver ounces that I purchased for a few days. Approximately 9 to 10 days, from Friday, March 9 until the delivery of the silver in a type of warehouse of the futures market. In this market, delivery is standardized on the second business day after expiration, which in this case, it would be March 19th. Therefore, the following carrying costs are incurred: storage, transport, and insurance of silver for 9 to 10 days. Also, financial costs for 9 to 10 days of the $30,000 related to the purchase of silver in the spot market. We also have net financial costs for 9 to 10 days of the $4,000 that we gave in cash guarantee. Here, I should point out that the guarantees may be remunerated by the clearinghouse and can be deducted from the gross financial cost. And finally, other types. In short,
If the cost of carry per silver ounce is less than 2 cents, remember that's the difference between the $6.20 and $6.22 per silver ounce, the arbitrageurs will do what they know best and take advantage of such opportunity. Otherwise, they won't. Therefore, the theoretical futures price must be the spot price plus the cost of carry or carrying cost. As the futures contract approaches expiration, the carrying cost decreases and therefore the difference between the spot price and the futures price decreases as well. On the expiration date of the futures contract, the futures price must coincide with the spot price, since in principle the carrying cost is zero. In short, the price of derivative instruments are based on arbitrage relationships and the law of one price. Arbitration consists of carrying out a simultaneous purchase and sale of products, quoted in markets linked to each other. For example, the spot market and the derivatives market, on the basis that their prices have been mismatched, buying what is undervalued and selling what is overvalued. Without going into much detail, the law of one price states that financial assets with similar cash flows must have the same price, and it also follows a no arbitrage condition. The effect of arbitrage in the markets is the rebalancing of prices. Arbitrage is responsible for balancing the supply and demand curves for futures and spot markets, so that sometimes, rather than talking about two different markets, futures and spot, one can talk about a same market or a same underlying asset, but with two different forms of negotiation. The first is the future price and the second is the spot price. Let me show you two final examples for calculating the theoretical future price. Here, we will cover some mathematical equations. But bear with me please, it's not rocket science. To begin with, the theoretical future price of a share of stock is calculated using the following formula. Fp equals Sp times 1 plus T times Rf minus D times 1 plus T prime times Rf prime, where Fp is the theoretical future price, Sp is the spot price of the share, Rf is the risk-free rate, D are the dividends paid before maturity. Here we have to remember that whenever a dividend is paid, the value of the stock decreases in the same amount of the dividend paid. T is the time until the expiration of the future. T prime is the time between the scheduled dividend payment today and the expiration of the future. And Rf prime is the risk-free rate as well, but it may be different from Rf due to differences in term or by considering Rf as the borrowing rate and Rf as a return rate. Given the following market situation, a share of Markats Inc. is quoted at $24. The risk-free nominal interest rate is 2.42%. The payment of dividends are 21 cents per share and is expected within 17 days. Then, what is the theoretical future price of a share of Markats Inc. if there are 30 days left until expiration? For this example, I chose simplified criteria where the interest rate Rf and Rf prime are the same, and where, in addition, the effects of withholding dividends are ignored, considering that they are paid in gross and net form. In the case of futures on shares, the cost of carry is basically the opportunity cost of the resources used, since there is no cost of storage, transport, insurance, or similar. They are futures that are settled in cash and not in physical delivery. The two components of carrying cost are interest and dividend. Finally, let's calculate the theoretical future price on the shares of the company SuperDuperMart for the bid and the ask. The information is as follows. The buying and selling prices, or bid-ask spread, of SuperDuperMart on the stock market at the moment are $19.98 and $20 respectively. The price of $19.98 means that $19.98 is the best price at which SuperDuperMart shares can be sold at this time. Likewise, the price of $20 means that $20 is the best price at which SuperDuperMart shares can be purchased at this moment. The days until expiration of the futures contract are 90 days. The interest rates in the money market for both the bid and the ask at 90 days for contract expiration are 2.78 and 2.85% respectively. That is, the bid of 2.78%
is the best interest rate demanded by the borrower at that time, as well as the highest level of interest at which you can lend money. In similar fashion, the ask of 2.85% is the best interest rate offered by the lender in that moment, as well as the lowest level of interest at which money can be borrowed. And finally, the expected immediate dividend and until the expiration date of the contract is 0, so there are no expected dividends in this case. Let's see the solution. It means that if you want to sell futures on super duper smart shares at this time, the theoretical future price is $20.12. And if you want to buy futures on super duper smart shares, the theoretical future price is $20.14. Phew! This is quite a topic. And so, we finally reached the end of part 1 of lecture 3 of this mini course. So far, we've covered new terms and concepts regarding futures trading, and I wouldn't want to saturate you with too much information in one go. In the second part, we will cover the process of hedging with financial futures, hedging against the risk of falling prices of the underlying asset, hedging percentages, and the lecture's wrap-up. And as always, if you liked the video, please like, subscribe, or share it with anyone you think could be useful. Dear viewer, this is Eric from Markats, and I hope to see you in the next video.
You hear me, babies? Good. Real good. Adios.